Hello and welcome to week 1 of managerial accounting. In this video, I'm going to cover the concepts that tend to confuse students. So I would suggest that you either read the book and or go through the videos before watching this, because I'm not going to go through, this isn't going to be a full lecture on both chapters. Like I said, I'm just going to capture the things that tend to be problematic. Okay, so in week 1, we cover the prologue. Right, and the prologue just basically puts managerial accounting into context within the broader scope of business. Right, and what I would suggest is that as you're going through this course, if you can try to attach the concepts to something that you've experienced in real life, either in your job or in an internship, it will make remembering things a lot easier if they're anchored to something else that you already know. And then in chapter 1, there's a lot of terms, and we're going to come back to these terms over and over again. So I just want to make sure that you are clear on the terms. So let's jump right in and talk about classifying costs. Right, so every business has costs, and we can classify them in a number of different ways depending on which question we're trying to answer. So first, let's start with the nature of costs, how they behave. So we can have variable, fixed, or mixed costs. And so variable costs are costs that stay the same per unit of activity, and so change in total. So variable costs stay the same per unit of activity, but change in total. So the easiest example to use in this course, in which we're going to use a lot, is just a manufacturing business. So unit of activity is going to basically be how many units we produce, okay? So one example for this would be, let's say we are a chair manufacturer. And let's say it costs us $10 per chair for wood. Okay, we make wooden chairs. So it's $10 per chair. So for every chair that we make, it costs us $10 in wood. So if we make 10 chairs, right, it's going to cost us $100. If we make 100 chairs, it's going to cost us $1,000. So see how it stays the same per unit, but it's going to change in total depending on how many units we make, okay? So that's a variable cost. A fixed cost is kind of the opposite. It's going to stay the same in total, and change per unit, okay? So an example of this would be, let's say, factory rent. Okay, so let's say our factory rent is $1,000 per month. Okay, it doesn't matter how many chairs we make, right? It's going to be $1,000 per month. So let's just say if we made 10 chairs, right? Our fixed cost is going to be 1,000 divided by 10. That fixed cost becomes $100 per chair. If we make 100 chairs, that $1,000 divided by 100 chairs gives us $10 per chair. Right, so a fixed cost stays the same per month. It's $100 per month, but it changes per unit, right, depending on the activity level. So, right, when we only make 10 chairs, it's costing us $100 in rent per chair. When we make 100 chairs, it's costing us only $10 per chair because we can spread that fixed cost out over more chairs. Okay, and then a mixed cost has a combination of both. One example of this, a good example, is your cell phone bill, right? Some of the plans now, right, they charge you a fixed amount, let's say $50 a month, right? Regardless, as long as you're within a range, it's $50 per month. And then they're going to charge you more per unit of data that you use after that. So it has both a fixed and a variable component. Okay, so that is one way to classify costs. Right, and this helps because when we're trying to budget for next period, right, knowing how the costs behave is very helpful. And we're going to do an example in just a minute. Okay, then we can also classify costs as product or period. So a product cost is anything associated with making the product. And let me just clarify here, we could be talking about a service, but just the easiest way to think about it as we're starting out is in a manufacturing business. So a product cost is any cost associated with making the product, and a period cost is not. It's everything else. Okay, and so there's two different ways to categorize product costs. There are direct product costs and indirect product costs. And direct costs are the ones that you can clearly identify within the product or trace directly to the product. So for example, up here in our wooden chair example, this wood is a direct cost because we can clearly trace the wood into the product. So this wood is called a direct material cost. And we can also have direct labor. So for example, if we have assembly line workers who only work when we're actually in a production phase, then the cost of that labor we can trace. Like we know how much we spent in assembly line workers per product. Okay, we're going to keep records that indicate that. Then there are indirect product costs, and this is everything else related to that product, but that's not directly traceable. So anything that has the word factory in front of it is going to be an indirect cost, indirect product cost. So for example, we can have factory depreciation, factory rent, factory utilities, okay? So these you can't obviously trace rent into your product, right? We're going to have to allocate that cost to the product. But because it has to do with the factory, right, we wouldn't have these costs if it wasn't for this product. These are indirect product costs. And then we have period costs. So these are the things, the costs that we have that are not associated with the product. And we generally break these down into selling and administrative. Right, and so for selling costs, we can have sales office depreciation, sales office rent, sales commissions, right, anything to do with the selling function. And then we have admin costs. So these are usually the costs that are associated with home office. So we could have CEO salary, headquarter rent, headquarter copy machine lease. Okay. So, right, we can break costs down into variable, fixed, or mixed. We can also break those same costs down into whether or not they're product or period costs. So, right, up here we determined that this wood was a variable cost and it's a product cost, right? Factory rent is a fixed cost and it's an indirect product cost. How about factory depreciation? If we go the other way, factory depreciation is an indirect product cost. Do you think it's variable, fixed, or mixed? Right. Generally speaking, we're going to consider it fixed, right? Our depreciation amount is not going to change depending on how many units we produce. Right, this would be a fixed cost. Same over here. We can do the same with any of these costs. Sales office depreciation is going to be a fixed cost. Sales office rent is a fixed cost, right? So what about sales commissions? Do you think sales commissions are variable, fixed, or mixed? It's a little confusing, but if you think about it, sales commissions are based on the number of units sold, right, which is related to how many we produce. So clearly, if we're trying to motivate our salespeople to sell more, and we're going to produce more if they do so, this is actually variable. So if we make more units because they're getting sold more, this number is going to go up in total, right? And if they don't sell anything, this number is going to go to 0. So it changes in total, right? So that's what a variable cost is. Stay the same per unit, but changes in total. Okay. So let's do an example here. Okay, so we're going to say that we made 100 chairs and that our costs are predictable at anywhere between us making 10 to 10,000 chairs. Okay, so this is called the relevant range. It means this is the range of production at which our costs are predictable. Right, so if somehow we needed to make 20,000 chairs because our salespeople were just on task this month, our rent wouldn't be the same. We would probably have to rent out another facility, and so then our rent expense wouldn't be fixed. It would change because we'd have to rent another facility. But within this range, and we are in that range, our costs are predictable. Okay, so the givens are that we only have variable and fixed costs, so no mixed costs. And it says at a production level of 100 chairs, so this is important, at a production level of 100 chairs, our total manufacturing cost is $27.50 per chair. And variable costs are 20% of the manufacturing cost at this production level. And we need to figure out, right, what are our fixed costs? And can we predict our total manufacturing costs if we produce 150 chairs, right? So this is a completely realistic business question, right? We want to know what happens to our costs if we increase our production. So I'm going to break this apart a little bit. So our total costs are made up of our fixed costs plus variable costs. Right, because they told us we don't have any mixed cost. And there's two ways we can look at this. We can look at this kind of in total for all 100 chairs, or we can look at it per unit. I'm going to do it both ways. So in total, what are our total costs? Right, well, they told us that our total cost is $27.50 per chair when we make 100 chairs. So $27.50 per chair times 100 chairs means that our total manufacturing cost is $27.50. Okay. We don't know our fixed cost here. This is what we're searching for. And our variable cost, they tell us, are 20% of the manufacturing cost at this production level. So if $27.50 is our total, 20% of that, so times 0.2, tells us that our total variable costs are $550. Okay? So if I take the $27.50 and subtract the $550, it tells me that my fixed costs are $2,200. Okay? So that's this, taken care of. We can also do it by per unit. So let's look at it per unit. So our per unit total cost, they told us up here, is $27.50. Okay. They told us our variable cost is 20% of this number, right? So we can take the $27.50, multiply it by 0.2, and you get $550. Right? And then if you subtract the two, $27.50 minus $550 gives you $22, right, per unit. Okay. So if we were to multiply this by 100, right, then we get the 2,200. So this is per unit, this is in total. Hopefully that makes sense. So some people prefer to work it this way, some people prefer to work it this way. So now let's answer the second question. Can we predict total manufacturing costs if we produce 150 chairs? Okay, so which of these costs are the same per unit, right? Variable costs are the same per unit. So we know that our variable costs are $5.50 per unit, but now we have 150 chairs that we're making, right? So I'm just going to do the math. That gives me $825 in variable costs. Okay. Do we know our fixed costs? Am I going to take 22 times 150 units? No, right? It's fixed costs. The beauty of fixed costs is that they stay the same in total regardless of the activity level. So the activity level is 100 chairs or 150 chairs. It's always going to be 2,200. Okay. So then if we add those together, we get 3025. Okay, so hopefully that makes sense, right? So remember, fixed costs stay the same in total regardless of the activity level. Okay. All right, the next concept that I want to talk about is differential versus sunk versus opportunity costs. And so the example I give you here is, let's say in 2021 you spent $10,000 for grad school, and in 2022 it's going to cost you another $20,000 to finish and get your degree. Okay, the question or the decision that needs to be made is, do you want to go or not go to grad school in 2022? So this is the decision. Right? The whole point of managerial accounting is to give you the information to make decisions. So differential cost is just what is the difference of the cost based on, in this case, the two decision points, right? So if you go, what is the cost going to be? It's going to be $20,000. If you don't go, obviously the cost is going to be $0,000. So the difference between the two is $20,000. So your differential cost is $20,000. Notice that I did not say the cost to go is $30,000. It's not 20 plus 10 because you already spent the 10. This 10 that you've already spent that you can't do anything about is called a sunk cost. Right? So it's pretty irrelevant to the decision, and actually what happens is people get emotionally attached to this number when there's nothing you can do about it. So really the question is, do I want to spend $20,000 to get my degree? Not, do I want to spend $30,000 to get my degree? Because you already spent the 10. Okay, and then the opportunity cost is the cost of what you're missing out on by making the decision. So if the question is go or not go, right, and let's say you decide to go, right, your opportunity cost could be that $20,000 could go towards a down payment on a house. So you're losing out on the opportunity to put money down on a house. You can have non-monetary opportunity costs, right? So if you go to grad school, one opportunity cost would be missing out on binge watching, I don't know, Peaky Blinders or something, right? So that is also an opportunity cost. Right? So this can be monetary or non-monetary. Okay, and the last thing that I just wanted to comment on is, hopefully you sort of remember from your last class the traditional income statement format, right? And just in a nutshell, it would be revenue or sales, same thing. Minus cost of goods sold gives you gross profit. Minus your operating expenses gives you net operating income. Okay, and sometimes people have a hard time figuring out this cost of goods sold with other information given. So if this number is not just given to you, how do you figure it out? So let me give you an example. Let's say we start off our beginning inventory number. So the cost of our inventory that's sitting in the warehouse, let's just say is $10. Right, so that is our cost, okay? And let's say that during the year, we purchase another $7 of inventory. So the total cost to us of our inventory items, right, that means items that we can sell to a third party, the total is $17. And so that's called the cost of goods available for sale, right? So during the period, you have $17 worth of goods that you could sell. And one of two things can happen. So I'm just going to do this. I have $17 in inventory that I could sell. You're either going to sell some of it and not sell some of it, okay? Now we could also have theft or breakage, but we're going to ignore that for now. So let's say you sell $9 worth of that, okay? How much did you not sell? Well, that means you didn't sell $8 worth, okay? So this number right here, so remember, this is our cost, okay? Not how much we sold anything for. This is our cost, not how much we sold it for. The cost of the goods that we sold is $9, right? So this is our cost of goods sold number, this right here. This cost of goods sold is this number. This, the amount we didn't sell, what is that called? Do you know? Right, that would be called our ending inventory. That's what's sitting in the warehouse at the end of the period. Okay, so basically an equation that you can always use if you're not given cost of goods sold would be beginning inventory plus purchases of inventory minus ending inventory. It's going to give you cost of goods sold. So let's just make sure that works. We have beginning inventory of 10 plus our purchases of 7 minus what's left over of 8 gives us $9 cost of goods sold. Okay. All right, so that is all I have for chapter 1. If you have other questions that I haven't covered, let me know.